We found two unusual trades, one of which is worth $203 million on Nvidia stock, ticker symbol NVDA. And what's also very unusual about this is that Nvidia reports earnings in 2 weeks on February 26. And so in this video, we will analyze these unusual option activities to find out if these wealthy investors are bullish and buying Nvidia before earnings or bearish and selling Nvidia. Because as we all know, the rich have more access to information, including leaked insider information such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into the data analysis of their trades so that we can level the playing field. As we can see here on the options time and sales tape, the first unusual trade was this 100,000 contract trade, along with this 81,500 contracts being traded at about the same time. These are the April 17 options at the 120 strike calls and the 110 strike calls. And based on our analysis, the 110 strike call was a closing trade, and this wealthy investor was rolling into a higher strike price, the 120 strike calls. And so if we calculate the total trade costs, where the price was 20.30, we need to multiply by 100 since each option represents 100 shares of stock, and we get $2,030 per call option. And since there was a total of 100,000 contracts, we multiply that out and we get a total of $203 million. And so quite a significant amount to be trading before earnings. But keep in mind, this is a higher risk trade in comparison to the trades that we share on our website. And so if you want to get access to the lower risk, higher probability of profit trades, make sure to go to our website. We will put a link to our website at the top here, because keep in mind, not all of these unusual trades will be profitable. Even this one might be a loss. But as long as we diversify with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. And so if you want more stocks wealthy investors are trading for your portfolio diversification, then go to our website. Now for the second unusual trade, we can see here these 32,100 contracts and the 29,090 contracts being traded at about the same time for these February 21st options and the April 17 options at the 130 strike calls. And based on our analysis, the February 21st options are closing trades, and the April 17 options at the 130 strike calls are the new opening trades. And so we can add these contracts up since they are the same strike price. And so we have 32,100 contracts plus 29,090 contracts, which is a total of 61,190 contracts. Now you may be wondering, is this wealthy investor buying or selling these options? Because we have red, which could mean sell, or green, which could mean buy. But actually, the colors do not mean buy or sell. In fact, the colors actually mean that the trade was being executed either closer to the bid price or closer to the ask price. So be aware of this so that we do not make wrong conclusions. And so when we estimate the total trade costs by multiplying by an estimated price of $13.65, you can see here that this trade was about $83.5 million. And if we dive deeper into this trade on the option chain, we can see here for these April 17 options at the 110 strike calls, you can see those 80,000 contracts that were being traded that we said earlier were closing trades. Well, you can see that the open interest is about 80,000. And so they were closing out of these and rolling 100,000 contracts at the 120 strike calls. We can see the open interest much less at 21,000. And so these were the new opening trades. And you can see here our position at the 130 strike calls where those 61,190 contracts were clearly new opening trades, since the open interest is much less at 27,856. And based on our analysis, they were buying these call options, which is why we are also in the same position. Green means buy in this case. And so we also bought these 130 strike calls. And when we analyze this trade, we can see here on the risk profile profit loss graph, where the x-axis represents the share price of Nvidia stock, which is currently trading over here. And the y-axis represents the profit loss. Note the zero break-even line here. And so when the purple and blue line is below it, it is a negative loss. If it is above it, it is a positive gain, because this is a long bullish trade. And we can confirm it here on the Greeks. We have a positive delta trade. But be aware of the risk on this trade. We have a negative theta decay. And that is why the purple line, which represents the current date, drops down to the blue line, which represents the expiration date. And so as time goes on, these call options will lose value. And that is why the break even shifts up to about $143.84. And so at expiration, Nvidia stock needs to trade above $143.84 a share for these call options to be profitable, even though it is a 130 strike price. And so that is another reason why this is a higher risk trade. And that is why we use position sizing to manage our risk, because we don't put a lot of capital into these higher risk earnings trades. We take a small position and put most of our capital into the lower risk, higher probability of profit trades that we share on our website. If you are interested in gaining access to those, we'll put a link to our website at the top here. Let us know in the comments below. After seeing this analysis of these two wealthy investors going long bullish on Nvidia stock, are you bullish and buying Nvidia stock? Or are you bearish and selling Nvidia stock? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.